Hey, welcome, everyone. I'm Lawrence Wintermeyer, and I'm the chair of GBBC Digital Finance, and I think we're on the penultimate leg, I think, or thereabouts, and what has been an outstanding day. So thank you very much to all of you for being so patient, and thank you to the GBBC team for really an outstanding event. This is unlocking the future of finance, and it's, I think, a particularly interesting topic in that predicting the future isn't something that I think many people are good at. I think it's often, people get stuck in the present and the barriers and how to change things and can't really understand how to, to move forward, which we often call, the incumbents. Particularly in highly regulated areas. And then we have in this space, which you will all know, a very technology literate community who have solutions for many things, but quite often don't either recognize that they're in a highly regulated space or that change requires quite a bit of social anthropological care to actually get execution and get done. And so, those of you that know me know that I'm not a big fan of predictions. I'm systematic risk adjusted. I love statistical probabilities, but some of my favorite predictions, and again, this is very important, Paul Krugman, the economist who we're familiar with in 1998 said, by 2005, it will become clear that the internet's impact on the economy will be no greater than the fax machine. I'm glad somebody's laughing. I love that. Thomas Watson, who was the chair of IBM in 1943, and arguably this was long before the tech revolution, wins though, which is that I think there is a world market for maybe 5 computers. I don't know why they got it wrong in the 70s with, Microsoft and the micro revolution, but there you go. So often in my life, I think that, my empirical experience, and I know having shared this with panelists as well, often we forget what job we're trying to do. And it's back to Clay Christensen's, what job does it do? What level of utility are we trying to provide to, to society, to businesses, to governments? And so I think if we look at the SDGs here, we are SDG 9 and 11, and that's important to put into context because we are really ultimately at some level talking about infrastructure. There clearly is adoption. There are a lot of things that need to go on, but we need to fundamentally focus on infrastructure. And I say this because without predicting the future, I think my observations would be if you look at Web 2, and cybercrime rates and how ineffective Web 2 is for doing most of the things that we want to do in the future, we'll need to change things if we want to get to Web 3 in the metaverse. And not just starting with security or infrastructure, but putting people and digital identity as a cornerstone of Web 3. So to help us unlock the future, I'm really joined by I think an esteemed panel. I've actually enjoyed the briefing, all of the conversations we have. We've got Val Szczepanik, who's the head of strategic hub at the SEC, the innovation head. We do have now, see now my notes aren't in order because I've asked you to sit I've scuppered myself here. We've got Viktor Prokopenya, who's the founder of currency.com. We've got Jennifer O'Rourke, who's the Director of Innovation, Strategy and Design at the DTCC. And we have Brian Whitehurst, Head of US Regulatory Affairs from Lukka. And last but not least, we have Jay Gdanski, who is the founder and the CEO of Evertas. So let's get started. And I'm going to sit down here. And Viktor, I'm going to start with you. When we started talking about the keys to unlocking the future of finance, you started talking about the acceleration rate and the literacy rates from the beginning of the 1900s right through to now, and how slow that was as a means of really giving everyone on the panel an idea of how complex that change is. And we need to be talking about financial literacy now. So what are some of the keys to unlocking the future of finance?
Yeah, thank you for the opportunity to speak here. I believe that like another story which I haven't probably told on our call was a story about a few cities in Canada, I think, just removed police from the streets for a few days, and they believe people are nice creatures and everything will be fine, and it wasn't. Basically, all of the bad things started to happen, and it doesn't look like we ever are going to be in a situation when you basically don't need any kind of regulation, any kind of enforcement. So, and I believe the future of finance is kind of very much connected between effectively education, which we've been speaking about, an increasing level of education of people, and regulation. So, and today a lot of regulatory work basically is required because people just simply don't understand the products which they are using and how they're using them. And but I believe it will change basically. And what will change is effectively, and what we've been talking about on the call is that 100 years ago, only 3% of people were literate. And if you ask them how many could be literate maximum in total society, they would say like 30. Today we have like 87% general literacy rate, and pretty much everybody can read and write, and it's considered to be normal. So, and I believe the same will happen with financial literacy. So we have like 3% financial literacy rate right now, and this needs to be changed, and this will change. And I believe one of the things which the industry, general financial industry, is responsible for doing is actually educating customers and raising the general level of understanding financial products, and then kind of we can live in a world with less regulation and basically in a more free society in every aspect. So.
Well, I just think that's an excellent place to start, because in addition to trying to be a bit more specific about what job we're trying to do and achieve in finance, that literacy rate is something that definitely needs to be improved. And Val, I noticed something particularly about the analytics that are going on in the SEC. Last week's announcements coming out of Washington, I think, were huge. I mean, we were in Washington last week, and I was exhausted by the end of the week. We had Chair Gensler in front of the Banking Committee. We had the President CEO framework. We had Chair Benham in front of the Senate Ag Committee. And I thought, well, I randomly picked one of the best weeks to be in Washington that I could. But what are the key messages from the SEC that our audience should take away on, the real key to the future of finance here from the perspective of the SEC?
Sure. Thank you. And thanks for having me. It's a real pleasure to be here and to listen to the discourse that's going on. It's really important to have. I think, and I'm speaking for myself, not necessarily for the SEC or my commissioners or one of my colleagues, but it seems to me, and you've mentioned people much smarter than me who couldn't make good predictions. So I won't pretend that I'm going to predict anything, but it seems to me that if this industry wants a broad adoption, that it's going to have to kind of adhere to some basic public policy kind of frameworks. This industry is looking to deal with people's assets, whether it's transferring them, safeguarding them, custodying them, giving advice around them. People have to realize it's a pretty highly regulated space for a good reason. People are entrusting others with their assets. And so there's basic things that have to go on. One of them is, of course, disclosure. People need to understand what they're getting into. The SEC is not a merit-based regulator. It's disclosure-based when it comes to most investment decisions. So we just want to make sure that people know what they're investing in, people know the risks. And then when it comes to secondary trading, it's all about market integrity, right? It's about fair access, fair rules. People know what's happening with their assets that are on the platform. They know that they're not being front run or traded against in a way that's not disclosed or unfair. So it's really about basic public policy frameworks. And I think the message that was coming from Chair Gensler and has been coming from him for a while is to try to encourage the staff to work with the industry to figure out ways to get that disclosure to investors and to figure out ways to get the platforms operating in a way that's consistent with the way that folks who are using them expect them to be operated. That is, fairly, with full disclosure, and knowing that they're playing on a level playing field. So with that said, my own thought is in order for us to go forward, there can't be silos. There can't be a regulatory silo where all regulation is going on. There can't be an industry silo where things are developing outside of any kind of communication. And part of what the FinHub is there for really is to interface with entrepreneurs and innovators and developers. And we have been doing that, for years now. And I think rather successfully. You don't always hear about the success stories, but we've had hundreds of meetings with folks, projects who want to come in and talk about what they're doing. And they get our feedback. We can't give advice, but we can ask a lot of questions, give feedback. And oftentimes people will think about, okay, well, maybe we'll do things a little bit differently. Maybe we need to talk to someone in a different agency like the CFTC or FinCEN. We can make that handoff for them. And oftentimes they go off and they'll do their thing, and you may not read about them because I don't know, they haven't they've done it and gone on their way. So I think I just want to stress that in order for the industry to flourish, I think there has to be a realization that it has to be done in a way that is regulatorily compliant. That doesn't mean that we have to be rigid. Even the chair has indicated that, when it comes to disclosure, we want to be flexible. There are examples of this in the past. For example, in the asset-backed space, when the staff talked a lot to the industry and figured out, well, this is the kind of disclosures that make sense in this space. Our disclosure rules are very flexible, and so we're able to work with industry around those kinds of things. And it's been done before. People have registered offerings of digital assets. People have gone through and gotten exemptions from registration. Others have gone through and gotten no action letters. So there are success stories. It's completely possible. And for folks who are kind of developing in this industry, it's compared to what you all are doing in terms of developing incredible technology, disclosure is not rocket science. So I would just encourage folks to come and really talk to the staff. And I think, our efforts are to help people avoid pitfalls, and we want to continue to do that.
Thanks, Val. And I just think it's important. I have to give a shout out to you because, quite often the discourse of the narrative really gets focused on the headlines. And I think when we first started doing taxonomies and codes of conduct in what we call the co-reg model or the collaborative model, Val and the SEC team, we were talking about it last night, in the old days, would video in with a team as observers of us, writing taxonomy and codes of conduct. Val actually went on to be the cornerstone of our own quarterly reg form, which is all about reg purviews. And so I just think that this is a complex space, and typically we have a lot of adults in the room, but there are a lot of progressive things going on that people seem to lose sight of. And so, I just think, your leadership in this area is something that we just greatly welcome, because we're all trying to move the dial here in a very complex, situation. So thank you. So Brian, here we go. TradFi's got a laundry list of, the items that they need to meet, for regulatory compliance. And as blockchain and crypto continues to mature, what are sort of some of the risk management processes and again, some of the tools that you see emerging that the industry should look for, to TradFi in order to demonstrate that they're accelerating? And I do have to say, we're a bit vested in this because we look at the DeFi community and say, gee, there's a whole set of composable things in the DeFi ecosystem, but there's standards in TradFi for quite a few of them.
Yeah, so crypto on its basis, there's a lot of people that feel that it's like the antithesis of traditional finance, that they're doing something that is completely separate, and a lot of the policies of traditional finance should not apply. But I think when you get down to it, there are risk management ideas that need to be applied in this space in order for it to become a fully mature market. I think if you were to ask your average retail investor what they believe is the system, they are going to rely on their traditional financing structure. That being, I go to a bank, I deposit money, it's safe, it's secure. I might make a little bit of interest rate off my savings account or whatever, but I know if I go to the bank, I can get it back. No questions asked. Whether that's always true is a different story, but that's the general belief. Similar with stocks, because of the disclosure system, as like Val was talking about, traditional system, people know what they're getting into from a risk standpoint. If you were to take, in the crypto industry, if you take Celsius, for instance, if you were to ask the majority of the investors as they were putting money into the system over time, how did they think, what did they think was happening to their money? I think most of them would have probably told you, oh, I can get it out, it's mine, it's sitting there, it's generating a yield, but I can always go and get it out, much like the traditional finance structure. Clearly that's not the case, and that system was not expanded upon, it was not explained. So I think what we need to do for the industry to grow and mature, we need to adopt some of these traditional financial risk management tools and apply them well before regulation ever sets in. I think we can get to a point that makes it more mature, and I think some of the things that we can apply very easily are things like focusing on substance over form. That being, when entities are developing their products, they're looking at everything before they send it to market, the legal definitions. They're looking at the effects that it will have internally and externally, how the volatility of any individual asset might be affected by what they're doing in the protocols are written out. So having that understanding before it goes to market is going to be very helpful to both them and their investors. I think then you also look at clarifying custody, collateralization, and segregation of assets. Very, very basic things that need to be done in this space, because you should, when you're putting stuff, when an investor's putting their money in, they need to know that how's it being custody, how's it being secured. Am I at risk of being hacked and losing everything at any one point in time? Kind of like today, I read the stories of what is a $140 million hack that happened last night or yesterday, and it's happening over and over again. So you need to have clarification around that, and also segregation of assets. Very basic principle: don't combine your corporate assets with your investor assets. It's not that difficult, but you're seeing a lot of that still going on in the crypto industry, and that can easily get taken out, which can help avoid a regulatory scrutiny. Much to Val's point, disclosures, enhanced disclosures is a baseline thing, in my opinion, that the industry can do to make sure that retail investors and institutional investors know what they're getting into, understanding the risks, being able to properly evaluate, and not putting themselves in a situation where they're handing over all their assets and they are effectively losing complete control over everything. And then when entities run into liquidity issues, they're at a loss. So if they know exactly what is being done, and these things that entities are doing, they're not trade secret. I see oftentimes like, oh, we can't disclose everything because that's trade secret. It's not. Let's make that clear. So it's doing advanced disclosures. And then lastly, I think understanding operational risks and not ignoring it. Data is very, very important to the future of this industry, and accurate data, making sure that you are able to tap into a blockchain, both on and off chain transactions, and being able to get your books in order for an accounting and tax purposes is unbelievably vital to the system and moving forward. And the more accurate your data, the better results you're going to have. And if you don't have trusted data, then you're losing from the beginning.
I love that comprehensive trawl through things, and often have to remind people that in either common law or code law, the practices that you were talking about need to be done in financial services, full stop. I mean, I don't know how some people think they can get around it. And, it creates an issue because we've got all of these blockchain advocates here, and, particularly in native blockchain, saying, look at all of the benefits of it. But policymakers say, but it looks like it's getting hacked and people are losing money. And how can it be so great, Lawrence, if this is all happening? And a lot of it is, specifically around the duty of obligations that you were speaking about, rather than just a Web 2 tech cyber hack. So I think that's, really coming to light. Jennifer, I'm going to move to you now because this is flowing nicely, and I don't want to get into my favorite topic of custody being the sort of Gordian knot of cryptocurrencies, which is where you guys are sort of focused on things, but you're really looking at the intersection of TradFi and DeFi, and then we kind of think DeFi is moving quicker than most things are on the planet, but we can come back to that. What's it actually going to sort of take to move the dial on that front? What's the big key to unlocking that intersection in the future of finance?
Yeah, I wish there was a silver bullet that I could share right now and say this one thing. This is what's going to do it, but it's going to be a combination of many things. So first and foremost, we need to have regulatorily clear mandates, and then those need to be followed through by the industry. And I think right now, because we have a variety of different participants in the DeFi space, with a variety of different experiences, some coming from traditional finance and others that are dipping their toe into finance for the first time because they're coming from more technology-based backgrounds, that they're learning still why we have these friction-filled regulations in place. And as they learn by doing, it's a little bit more difficult for them sometimes to appreciate why we actually have those in place. When we have some participants that look at DeFi as a method of accessing a more optimized peer-to-peer transaction that can circumvent regulation, they aren't fully understanding that the regulation is there for a reason. And that reason not only protects the participants, but it protects the system as well, the system that they are creating. And I think the other thing that's missing is an understanding that not all friction is bad. Friction can throttle an erratic or hyper-accelerated development that does not sit as soundly in financial services because of this lack of rules, regulations, compliance, and protections. And so these friction points are not necessarily bad things because they allow the system to trip up in smaller ways so that they don't fall flat on their face in big ways. So I think, regulatory clarity and then actually enforcement around that and participation within those frameworks is going to be really important. Another component that I want to highlight is digital identity. And although that's been given a bit more of a spotlight due to Web 5 now, right? The absence of digital identity in Web 3 birthed Web 5, amongst other things. So that conversation, I think, has highlighted the need for digital identity to a degree, but there's an incredible emphasis that we need to put upon exploring the different architectures that we can deploy digital identity in and what that would mean to essentially solving some of the problems and smoothing some of the friction that we have in DeFi right now in a way that TradFi already enjoys through things like AML, KYC, and it's just some of the gates that we don't take for granted, but others that are newer to the finance space may. And then the last thing that I'll say, and this isn't really specific to DeFi, but I think just broadly about proliferation around digital assets, I think there's an incredible opportunity for P3s or public-private partnerships, really thinking about the way that the private sector and the public sector will be working together in highly specialized use cases to deliver very specific solutions is going to be a way that we can accelerate the adoption and also the socialization, the understanding of some of these solutions as well.
Yeah, very cool. I mean, I'm going to come back to if we have enough time in the second round part of the scaling, not quite safe harbor stuff, but how we get the right sequencing and pacing of technology in place so that we can actually scale things. But I'm horrified now that there's a Web 5 and I didn't even know about it. I'm just trying to catch up with Web 3. And now I know I'll have, public company CEOs calling me tomorrow and saying, my God, what the hell's the Web 5 thing? And what was Web 4, Yeah.
So combination of Web 3 and Web 2 has now brought us Web 5. It's a little bit of a play on numbers.
This sounds like technology evangelist math. If you're a quant, you're just like, what? Anyway, sorry, let's moving quickly. Last but not least, Jay, and then we're bagging it because this is the second panel we've done in 2 weeks. So I don't know if you're in Paris next week, but well, that would be cool. But let's come from the side of insurance. And again, I think it's an emerging area. In fact, I really don't understand much about insurance and the role that it plays, particularly in a digitally decentralized world. And so I think at this, particular juncture of what, a key of the keys of trying to unlock the future of finance, what the Clay Christensen, what's the job, what's the utility that insurance is going to play, and how's it going to help us either make it better, scale it, protect us?
Well, in a totally self-serving statement, I do have a silver bullet, and it's called insurance. Regulators, you should require it, and customers, you should buy it.
Nobody's laughing but me.
I was going to say agree to disagree, but I'm sure it's a very important component. I want to hear more.
It's interesting because insurance, not many people understand insurance, actually. I'd say even many people in the insurance industry don't. If you want
best risk managers in the world.
Right. Well, if they're doing their jobs right. Look, the history of kind of industry professionalization, industry maturation, standardization, and risk reduction, that's all being driven by insurance. You can go back to fire safety standards, you can go back to auto safety standards, you can consumer product safety. That's all been driven by the insurance industry, right? If you're in the US and you buy a car, you don't really care what the federal government tells you the rating on your car is, you care what the Insurance Institute tells you what the rating of your car is. That's because they're the ones who have to be on top of what developments are in an industry, and they have a very strong financial incentive to make sure they get it right. Within this space right now, there really isn't a lot of focus on building purpose-built solutions, right? And so what you have is people who don't really understand the technology coming in and trying to create insurance products. On the other hand, you have people who don't understand insurance trying to create tokens that number go up kind of thing, which has its own problems. And so you do need a mature insurance industry, and you need a mature insurance infrastructure. And it's interesting because if you go down the list of infrastructure that we've built for crypto, right? Banks, yeah, we need that. Exchanges, yep, absolutely need those too. And software and data providers, and we need our own reporting standards, we need our own technical standards. And you say, what about insurance? Like, you know what? Those people who are really slow moving and conservative and are like 400 plus years old, they got this covered, right? It's not. It's kind of a really glaring omission, and the truth is that there are major financial deals that have not happened because of the lack of insurance. But more importantly, you're not going to get to a level of the standardization, the risk reduction, and really the robustness of infrastructure without insurance. And that's been shown time and time again across multiple industries. And what we're doing is we're bringing that market to bear. We are increasing capacity for insurance. And while obviously it's not a silver bullet on its own, it actually tends to engender many of the things that are necessary for a mature, safe, responsible industry. And it also tends to do it much more effectively than purely industry-driven efforts, and much more effectively than regulatory-driven efforts. And you've seen this historically, say what you will about cyber insurance, and there's much to say. But the SEC required it, I think about a decade ago, for public companies to have cyber insurance, because even that was a significant improvement in their cybersecurity posture and protection, which obviously would protect their investors as well as their the users of their products.
Well, I love that, and having spent time in the global reinsurance market in the London, reinsurance market, I think they're very good at risk management and pricing risk in most things. Not that they don't make mistakes. But just quickly now, I've got a panel that we're on the clock, so I think we'll just go backwards. And I'm just going to continue if we just keep these responses brief so that we can get everyone in the next 10 minutes. So where are we going to have specific crypto insurance companies? Is it going to be part of a Swiss? I know that, well, that's you, but where is this going? I mean, do we need, because this is really related, and you mentioned, well, this is related to cyber. So where the experience comes and how you actually price risk in this space must be crazy.
Well, I think anyone has to be crazy to start a company, but cyber actually is, not to bore you with the history of crypto insurance, but it's actually not a good home for it. Cyber and the way it was built was not designed for kind of theft, loss of assets, or even like tech E&O or business continuity type of perils. I know insurance always is great at parties because then no one speaks to you, so you can just be left alone to hang out with your friends or get food. But ultimately, you do not see successful industries without insurance. The idea that the incumbent insurance companies are going to get there is false. You have $5 to $6 billion of insurance capacity that's been roughly flat even when we were at a $3 trillion market cap. That's ridiculous. You have major entities with, at one point, $100 billion of assets with, $200 to $300 million of insurance. Ask our good friend from the SEC how often that happens in the regulated public markets. And, you start seeing there's a real problem there. On the kind of crypto native side, like I said, the solutions that have come out, you have some people that claim to specialize in it, but they have no crypto expertise in their firm. And then you have crypto companies that are trying to solve it. And what you've seen is really good projects have a token that increases in value. You tend not to see projects that actually are providing meaningful risk transference and that are sustainable at an actuarial level before you start dealing with product issues or governance issues. And so it has to be built. It's why I've been doing this for 5 years. It has become a real problem. People have regulatory requirements. We're seeing investors that are requiring it from their customers. We're seeing people viewing it as a differentiation between people who are and are not responsible players. If there's no insurance, it will continue to hold back the market as we have seen it for the last several years.
No, and I think that's excellent. I just think, there is a capacity as your resource constraints in highly technical areas. So, and this seems to be one we need to keep an eye on because it is important and ultimately there's a high utility in it. So Jennifer, on the many-led digital principles, again, back to, we start off and things say, would an atomic settlement be great? We need to get to T1, we need to get to T0. But we don't actually often look at either the ecosystem, the problem, the counterparties, even if we're digitizing it all. So what are your thoughts on that? And I'm really keen on, again, the optionality of strategies, even as part of a scaling strategy, which is, that we put speed bumps in until we work out how this stuff works so that we don't blow everything up.
Yeah, Lawrence, I think you hit the nail on the head. It's about optionality here. And as we look at digital assets, we see how they can facilitate accelerated settlement. And that's incredibly interesting because what does accelerated settlement mean? It means that less collateral needs to be put up because there are fewer margin requirements. And that means that you don't have the same capital requirements to actually transact that you do because simply of this speed to settlement. That's definitely a solution that we want to provide our clients at DTCC. And so we've been exploring it through a variety of different ways. There are ways that we can use traditional technology and traditional architectures and infrastructure to do this because we need to be thoughtful about market structure, particular products, the way that these financial instruments, transact, and are there benefits actually in trading in and out of certain strategies where you would prefer a T2 settlement or a T1 settlement as opposed to a T0 settlement. So there is a lot of thoughtfulness around what we can do right now today. At the same time, we're thinking about how we can leverage these emerging technologies and specifically networked solutions with distributed ledger technology to really think about how we can accelerate settlement too. So when we start to think about tokenizing assets and having tokenized representations of assets like security assets, things get really interesting. When we think about what it could look like to tokenize cash, and to have a tokenized or a natively tokenized representation of cash, things also start to get interesting. When you put those two things together, things get extraordinarily interesting, and you really start to see the benefit of accelerated settlement. So we're doing some incredible work at DTCC with the Digital Dollar Project around exploring central bank digital currency and settling wholesale securities transactions that have been tokenized. So we are experimenting with that scenario ourselves right now. And we're, as I said, at the same time, working with industry participants to leverage current technologies and current solutions that we have in place to also deliver the same benefits. So it really does come down to that optionality. We don't want to put our clients or anyone in the industry in a position where you're now forced to have a significant technology debt to participate in a solution that you may not be ready for right now, even though you know you may need to be ready for it in the future. And so that optionality becomes very important, not just to us, but to all the participants in the transaction.
I love that because, that's operative. And I think not a lot of people don't necessarily get it, but that's the technology debt that's associated with that in this case is an impeding liability. So, right, we've got 6 minutes on the clock, which I think gives us 2 minutes each, no pressure. But Brian, if you've given us the keys, which are pay attention to the laundry list, because there's a lot of things there that you could use to demonstrate that you're being an adult. How should what would you how are you advising crypto or blockchain companies, particularly about their strategy and their compliance strategy as it relates to the emerging risk risk landscape that you see regulation going down?
Yeah, so obviously regulation is coming, and what form that takes in the next year or two is anyone's guess. And chances are the industry is not going to be entirely happy with it, no matter what form it takes. But I think what companies need to start doing now in advance of that is evaluating what they have and how they can use tools that are available now to make sure that they're ready for that time. Every piece of legislation that's come out thus far has had an audit portion involved in it some way or form. So get ready for those audits that are coming. Make sure that you have your data in place and your tools in place. Fair market valuations of any crypto you have on your books is going to be a necessity. It's going to move past the point of, oh, I have X wallet address, and let me see what is the price of Bitcoin at any one point in time on CoinMarketCap and a multiplier. You have to have like a fair market value to be able to meet GAP and IOSCO protocols and standards. So I think that's one thing is going to be hugely important moving forward. Being able to do fair market valuations of implied volatilities and derivatives, NFTs, all these things are going to be coming that companies need to start thinking about now in order to prepare for the regulation coming down the line, along with insurance.
I love that because I think for all of you, you standards and certification geeks out there, this is hugely important because you're going to hit a level of audit with this, and it's coming. Thank you, Brian. And then Val, I just want to talk to you a bit about DeFi and actually get your personal view on it, rather than an SEC view, because it is. I'm not sure what the SEC view is on it, but I think, and then the important bits of it is that I don't know how many of you know, Val actually really led the IOSCO report work, particularly identifying the risks in the DeFi ecosystem. And that for most of us in industry, and certainly the Industry Association, was a benchmark. I mean, there's a lot of really good stuff out there. So I'm asking you from the informed perspective of actually having said, okay, we've looked at all of the risks now, but how important is it an area, particularly to the future of finance? Because we were speaking last night about Singapore and Australia. We know that there's a bit going on under the cover of Level 1 now in MiCA. Certainly the UK is very much focused on it. And, really putting in place, broadly legal DAO structures is what seems to be emerging pretty quickly. But could we just get your thoughts on that sort of DeFi space?
Sure, thanks. And I think what we tried to do in the IOSCO report was really give everyone a level set of facts and kind of take apart the prototype activities that we're seeing in DeFi and explain it in terms where people understand what's going on. I think it's critically important that regulators around the world and policymakers have a clear understanding of what's going on so that they can regulate and make policy in an informed way. And so that's what the report attempts to do. It attempts to really just set out the facts. This is what's happening in DeFi. It's up to the jurisdictions really to apply their laws and figure out what they're going to do with it. I can tell you that the whole world is paying attention to DeFi. There's going to be work. There's going to be continuing work in IOSCO. We're going to do phase 2 of the report. There's work going on at the FSB level. There's work going on at the FATF level, and there's work domestically. And you see some of that playing out in some of the executive order reports that came out last week. There's still more to come, but I think what you see is a lot of attention being paid to stablecoins, DeFi, crypto in general. And I don't think it's a bad thing. I think regulators and policymakers around the world saw 600 billion in losses happen in the recent market turmoil that affected investors and markets and retail. And that's not a position that anyone really wants to be in. That's not a way to flourish as an industry. People need to feel that the structures are in place, risk management is in place, safety nets. And so I think with DeFi, there's a lot of experimentation going on. But I also see that it's very doable to have compliance built into the technology. There were token standards that built in abilities to have restricted periods, have freezing of assets, reissuance of assets. We look at the industry and people thought the travel rule was impossible to comply with, but yet solutions came out in practically no time. And there have been protocols in DeFi that we've seen that have kind of institutional wrappers around them to ensure that AML, CFT, policies are complied with. So I think the technology's there. People know that they can build it in. There's just this reluctance to do it. And I think once people realize that building these things in from the beginning is going to give you the longevity, is going to give you that safety net against the regulator who's asking you, why didn't you do this from the beginning? You knew how to do it. I think when people realize that there's benefit in taking that approach, that's when this industry will turn in a different direction. And I think with DeFi, there's a lot of experimentation. Folks need to understand it may not be suitable for retail right now. Just the way these things operate, there's just a lot of vulnerabilities, bugs. If you read the report, it goes into all the various risks and it goes into also regulatory challenges. But again, it's a really young industry and it's fast evolving. And I think it can evolve in the right direction if we use the technology to build in the kinds of policy and safety nets that we have now with regulation.
No, thanks, Val. And I have to put in a plug for GBBC and GBBC Digital Finance because we've got an IOSCO affiliate membership application pending approval, which is, we think, the means to really work with DeFi and all of the work that's being done at IOSCO. And it's important to us to be the first, digital assets association to, broadly be working in that TradFi association context. So we're on the clock here, but this is really important because, Viktor, we started discussing, and this gets back to how in the 20th century, I think was arguably the century for great social decentralization. So you can talk about anything, but decentralization was a key part of how the 20th century scaled. But what role does that decentralization have to play in the financial system and really helping to extend, the integrity of democracy?
Yeah. So, our panel is named "Unlocking the Future of Finance," but it looks more like a regulatory panel. And I think basically there is a very good reason for it because it's all about building trust. And in this decentralized world, but the underlying effect of all of this is basically that the more education we have, the more participation in financial markets we have, the more decentralized decision making in the end of the day we have. So now in the economical system, which is currently organized through the stock market, effectively is a democracy, is a direct democracy machine. So people are bidding on different assets, and basically they say, for example, like if Facebook used to be like 100 PE ratio. It means people on General Motors was like 3. It means people want more funny cat videos than cars, basically, and effectively they're explaining the world through this what they want. And it's not always as funny as this example because, for example, if they're saying like Tesla has market cap of 1 trillion and all the other automotive industry, which is not doing basically the electrical vehicle stuff, is valued much, much less. It means that people are saying to the industry that we want electrical vehicles, basically, we want to see our world green. Basically, they don't want to happen. So, and so I believe sort of like if the trust is going to be there, basically in 10 years' time, because of proper regulation, because of proper kind of ethical behavior of people and education in the system. So you'll see more and more instruments for the decentralized decision making in the future and more democracy in the end of the day, which is great for society. Actually, thank you.
I love it. I know we're a couple of minutes over, so I do apologize, but I'd like to thank my esteemed guests because this was just an outstanding panel. I'd like to thank you all for listening, and it's so great to be back in person. I've done more hugging and seen more friends here in New York in the past couple of days. So it's just been fantastic. Thank you very much.